Hello, winning investor nation. Happy Labor Day weekend for our US watchers. It's Friday morning, and Ian and I are here recording this Market Insights video just a bit early, as our offices will be closed in observance of Labor Day this coming Monday. But we're glad that you've joined us. So good to see you. And please remember to give us a thumbs up, as it does help support the channel, and subscribe to our channel and click that notification bell so you'll know when new videos are posted. So hello, Ian. Happy pre-Labor Day weekend.
Hey, yeah. Hey, Amber. Happy Labor Day weekend.
Well, it is a day of notable economic releases. So if we can start with that, if you like.
Absolutely.
Okay, so the numbers are in the August job numbers, that is, and the report shows that the numbers exceeded expectations. U.S. employers actually added 315,000 jobs in August. Economists are expecting an increase of 298,000 jobs. Though less than July's print, this number is still a healthy number. Also, in the jobs report, the U.S. unemployment rate unexpectedly rose to 3.7% from 3.5% in July. Normally, this is seen as bad, but this rate actually rose for positive reasons, and it's all due to an increase in labor force participation. This number rose 0.3 percentage points to 62.4%, which means more people were in the labor force working or looking for work. Plus, even though the report showed a slowing in hourly wage growth, wages are still climbing faster than the Fed would like. So in short, the labor market is running hot, hot, hot right now. And what this means is that the Fed will very, very likely raise rates, obviously on September 21st. And it's a coin toss, but likely the hike will be between 50 basis points and 75 basis points. They'll raise rates until they're satisfied inflation is no longer a threat to U.S. economy. The Fed will need to see a few months of economic releases that show notable slowdowns, especially in the labor market. And this is what's needed to move them in a direction of easing or ceasing rate hikes in general. And just one other point, Ian, I wanted to show you that checking out other recent employment data, the JOLTS July number for job openings was released on Tuesday, August 30th, and it showed a near record of job openings, emphasizing a continued unrelenting tightness in the labor market as employers actually compete for a limited supply of workers. The number of available positions increased from 11.2 million in the month, topping all estimates. And it's statistics like this, labor market stats, that the Fed is watching in their totality to make their decisions on the course of action where further rate hikes are concerned. So how do you feel about the jobs number, Ian? How did it?
Okay, thank you. That's the problem right there. The number of available jobs is about 2 to 1 to number of workers.
Right.
And I think the Fed wants to see that gap close, before they stop raising, they are satisfied the economy is officially slowing down.
Right.
This jobs report was pretty good. It showed the economy is still growing, although at a slower pace than it was previously.
Right.
And what the Fed has to do now kind of reminds me of a T-shirt that I once saw in New Orleans, and it was a little pirate T-shirt, and it said, "The beatings will continue until morale improves." And when I think about how that applies to the market, it's the Fed is giving the economy a taste of, some medicine to try to slow it down with higher rates. And as you said, we're going to get a 75 basis point increase this month. That's what Fed funds futures are predicting. Jerome Powell knows, he looks at Fed fund futures. The rest of the Fed looks at that as well. They don't want to rock the boat. They want to make sure that they are, kind of being as transparent as possible. The market thinks they're getting 75. You're going to get 75. And I think this jobs report solidifies the need for another 75 basis points. Now, looking forward, there's two things that could happen. We could either have a hard landing, right, a prolonged recession, or we could have a soft landing. It seems more likely than not that the landing is going to be soft, just because of the way that things are starting to gradually decelerate. And, there's some other signs in the economy that things are starting to slow down. Mortgage rates are at 6.25%, which means that the housing market is going to start to slow down, which is a huge, part of the economy. You see the number of used cars on the market has increased pretty significantly the last couple of months. So people aren't buying as many cars as they were a few months ago. And there are a lot of other indicators, such as the price of oil and gasoline, that are dropping, that you're starting to see inflation drop. So, I think this number was pretty much in line with what everyone was expecting, and we're still sort of decelerating on a way that is more significant or indicative, of a soft landing than a hard landing. And at some point, the market will recognize that, and I think we'll start to see another rally.
Okay, I agree with you wholeheartedly, Ian. So, Ian, just before we got on our call today, you were mentioning some activity in the 10-year treasury. Would you mind expounding on that for our viewers? I was fascinated with what you were
Would love to. So I just want to share this chart with everyone. This is the TNX, and it is an index that tracks the yield on the U.S. 10-year note. The U.S. 10-year, in my mind and many investors' mind, is the most important market in the entire world, because it is basically what all financial products are based off of, the majority of them, in the financial and credit markets. It's the most liquid market in the world as well. Now, we have seen the yield go from about 2.5% in early August to 3.3% yesterday. And we had a big gap up yesterday morning. What I see, what was happening is that as interest rates increase, it means that prepayment speeds in the mortgage market slow down, right? If you have locked yourself into, let's say, a 3% mortgage, and now rates are 6% in mortgage, you're not going to go and refinance. So the mortgage bonds that are held by institutions and hedge funds and desks across Wall Street now actually have slower prepayment speeds. So that increases the duration on that bond portfolio. And what these institutional managers have to do is sell 10-year treasuries to hedge what's called convexity. And we saw a lot of that yesterday, a lot of convexity hedging. And now with the jobs number not being as, showing like last month that the economy was accelerating, you're not seeing a sell-off in the treasury market. You're actually seeing people buying bonds, thinking because the Fed is now going to raise rates by 75 basis points and the economy is going to be slower 6 months from now. So my biggest fear in terms from a stock market perspective is to see the bond market get out of control. You don't want to see 3.5% on the US 10-year on this chart. You don't want to, because then it's going to 4%, then 4.5%, and then we could be running into this scenario where the Fed has sort of lost control of the bond market. But this is good news today that we aren't seeing that acceleration higher in yields. And the inverse of that is people are selling bonds as yields go up. So yesterday we had a lot of convexity hedging. We're not seeing it today. We're not seeing a sell-off in the bond market. And I think, that's a good thing, and that should stabilize stocks going forward.
Okay. Oh, thank you very much for expounding on that thought. I'm glad you did that, Ian. So I'd like to just touch on the economic calendar for the shortened holiday week. So due to the shortened holiday week, there's actually just one major economic release to watch, and that will be July's trade balance, which will post on September 7th at 8:30 a.m. This release, of just so everyone knows, actually measures the difference between the movement in merchandise trade or services leaving a country, which is just exports, and entering a country, which are the imports. So economists are expecting the trade gap to narrow further to $70.1 billion from $79.6 billion, which was already the smallest deficit this year, where imports are concerned after building up inventories earlier this year to actually just offset the supply chain issues. Businesses are slowing down their pace of importing goods and merchandise. So this is all while U.S. consumers our spending habits are shifting to buying more experiences like travel or entertainment rather than physical goods for our homes. So, and since we know that the Federal Reserve's rate decisions will be data dependent, we are starting to see one metric that may help influence a less Fed hawkish stance, and it's all about softening prices. So as seen in this chart, easing price pressures are starting to show. The New York Fed's Global Supply Chain Pressure Index, Ian, actually fell to the lowest level since 2021. This is a third month in a row. Short-term shipping rates and ocean transit times are declining. Plus, companies are starting to complain that they just have too much inventory. So this is all kind of boding well for lower prices in the future and hopefully dampening this inflation situation that we're in. So we shall see. So I just
That's
wanted
a
to.
great sign. And then I'd also note one thing,
Mhm.
if you even look around, Labor Day weekend sales are everywhere right now, right? Whether it
They
be
are.
furniture or clothes, if you're on social media, you're probably getting those ads. And that's just a sign that a lot of these companies have built up inventories and now prices are coming down. So that's going to be good for the inflation metrics going forward, the CPI and whatnot, because these prices are going to filter into it. So that's a good sign that what the Fed is doing. Remember, the beatings are going to continue until morale improves. We
Right.
might not need as many beatings as we thought if we continue to see a decline in prices, Amber.
Fingers crossed, Ian. Fingers crossed. So I like to actually, we have move on to cryptocurrency market, and we have two questions that have come in through our YouTube comment section on the YouTube channel. If you do have a question for us, please feel free to post a comment there. We'll aim to get to it as soon as possible on our next video. But Ian, we have a question that's come in from James, and James is asking the following. James would like to know, Ian, you mentioned Solana. Why didn't you recommend that in your strategic fortune service? And then also, Ian, Lendo just would like to know if Solana is a buy. So the questions are all about Solana.
Okay, Solana. Hey, James, thanks for writing in. First and foremost, I have a number of investment newsletters. First is Strategic Fortunes, then I also have a more crypto-focused service. I recommended Solana in the crypto service, which does a more of a deeper dive, more research, and specifically focus on crypto topics. So if you want to subscribe to that, you can. I have recommended, I think, 5 cryptocurrencies and strategic fortunes. Those were all sort of the leaders in their respective sectors. And then in the crypto newsletter, we go a little bit more in depth with the research. So we recommended Solana, I guess it'll be almost 2 years ago, December 2020, right? Almost 2 years ago in December. I think it was like $1.60 a token. The thing ran up to $250. It was an incredible trade. Everyone was really happy with it. And so Linda's question is, do I still recommend it? Yes, I think that Solana is a key cryptocurrency, and here's why. It's very similar to Ethereum in the sense that you can build new projects on top of it. You can build decentralized finance and non-fungible tokens, which are NFTs. You can build all types of resources which help us provision digital resources better, like cloud and network bandwidth. More recently, the Helium network is migrating to Solana, so that's a big win for Solana. How they're going to have the Helium token on top of it, which allows you to basically pay for network bandwidth from somebody else who wants to provide it. And I think my thesis for Solana is that there's just so much development going on top of it, where they're releasing a Solana phone where you can build decentralized applications purely for mobile on top of their phone, which is already sold out in pre-sales. They're building stores to create more awareness of the Solana blockchain all across the country. There's one actually in Miami that I'm going to go visit within the next month. And they have basically FTX, which is a competitor to Coinbase. It's a centralized exchange run by Sam Bankman-Fried, who I look at as the Jeff Bezos of the crypto space. And he is building decentralized applications on top of Solana. So, if you want to go where the most development is happening, you have to follow the smart people in the space. And Sam Bankman-Fried is, in my mind, the Jeff Bezos of crypto. And if you follow Jeff Bezos back in the old internet days, that worked out pretty well. So I would just stick with the teams that are creating new applications and have had success doing that already, and will probably parlay that success into new decentralized applications. So I'm a bull on Solana. I know the price is down significantly, but it's similar whenever you see any new technology that comes out, especially every cryptocurrency. You saw the same pattern in Bitcoin. and Ethereum, where they had these big run-ups and then they had the pullback and everybody said, oh, they're dead, nobody's doing anything. And then they gradually came back and went to all-time highs. Same thing happened in Solana. It just has sort of a 4-year it came 4 years after Ethereum. So, Ethereum came 4 years after Bitcoin, then Solana coming 4 years after Ethereum. It has very, very similar characteristics of each of those bull and bust cycles. And I expect Solana to be much higher in the next couple of years.
Okay. Actually, while you're
and thanks for the question, Linda.
Oh, yes. Both James and Linda, thank you for your questions, especially Linda. Always good to see Linda online. So, Ian, yes, in our I have one more topic to cover in our mega trend news, and I think it may be a fun topic to cover. It's actual annual survey from the Strategic Vision, and they surveyed 200,000 new vehicle owners. And the survey asked, what car manufacturing brand and quality do they consider and love? For the first time, Ian, Apple was included among the more than 45 brands surveyed. And consumers actually came in saying 26% of them said that they would definitely consider buying an Apple car just behind Toyota and Honda. And 24% of the respondents said, I love it, when asked their impression of the quality of Apple brand, beating all the other brands by a wide margin, including Tesla. So Bloomberg actually has reported that Apple is shooting for a fully autonomous vehicle, electric vehicle, and aims to have one ready for around 2025. And what's most interesting is that over 50% of Tesla owners surveyed said they would actually definitely consider buying a future Apple vehicle. And the president of Strategic Vision actually said, quote, everyone should be prepared. So I just said, well, we all know about our iPhones. People seem to want an Apple car. It takes a lot to get a car manufactured. It's a monumental feat, but Apple looks like they may have a waiting audience when they're ready.
Did you hear that, Tim Cook?
We'll see what he does.
Well, Apple's got $100 billion on their balance sheet. They've got, more money than every country in the world sitting aside. And you think about mobility, this is a $6 or $7 trillion industry globally. And we're increasingly seeing that transportation is coming more of a software problem to solve, right? Like the hardware part of transportation is easy. You can have a contract manufacturer like Magna, which can put your cars together, but it's all about how can you connect all these sensors and chips and power sensors in your car. And so, people understand that Apple is one of the best at creating new types of technology products. And it would not surprise me in the least to see Apple release a car, knowing how big this market could potentially be in the next 5 or 10 years. And I'd buy an Apple car. I mean, I have every other Apple device under the sun, so why not just throw a car into the mix?
Throw a car in.
How about you?
I would buy an Apple car too. Yes, Tesla, Apple car. Either one is fine with me. Because how long have we been using Apple products? I've been using their phone since it first came out. I know you probably have too. So I'm used to them.
I mean, I'd buy an Apple car if it means that, like, when my car sends me a text message, I don't get a green text message. I have to get the blue iMessage text message. I don't know if you have an iPhone and then you have friends that don't have an iPhone and they send you a green text message and, you almost want to ignore it, right? But if my car is going to tell me, hey, we're ready to go, and it sends me the green text message,
you're not going to.
Yeah, I might have to hit the dealership. Yeah.
Funny, Ian. And so to our viewers, would you consider buying an Apple car? Do you agree with the survey participants? We love to know. Would it be an Apple car, a Tesla, or something else? Please let us know in the comments below. Well, Ian, I think that wraps up for this holiday week. So do you have anything you'd like to add before we sign off?
No, we covered a lot. We talked about the market and the bond market, and I think this week really was sort of a light week in terms of volume, and what you might be seeing a lot of volatility in the market is because a lot of these desks are, skeleton crew. The bosses are all on the beaches and the mountains and they're away. And that's why you saw volatility this week down, and we'll probably see upside volatility now today because, the leadership is all at the beach. So
On vacation.
this is like one of those weeks, like we said a couple of weeks ago, prepare for some excess volatility the next few weeks, because the junior staffers are running things right now.
Oh my goodness. Well, it has come to fruition. So speaking of vacations and holidays, we wish everyone watching who are celebrating Labor Day a glorious and relaxing Labor Day holiday. Thank you for tuning in and watching us. And from me and Ian, Ian can say goodbye, but I just like to say, if you do want to follow us on Twitter, we are at Invest with Ian and at A Lancaster Guru. And I just wish everyone a wonderful day ahead.
Happy Labor Day, Amber.
Same to you, Ian.
See you next week.
See you next week. Bye-bye.